I wanted to cover a common mistake that I'm seeing a lot of investors and traders make that are amateurs to the market. They always will, let's say the market's exploding, it's going nuts, or, they're worried about some pending war, which has always happened. They end up fumbling the ball nearly every time whenever they buy a naked SPY put long term, or, and a lot of times they get lucky, sometimes they do, sometimes they don't, or UVXY. The problem with both UVXY or VXX, these run inverse the market. Let me talk about the problem here and the solution. These run VIX and let's say UVXY, they run inverse the market. Where's the overall direction on this? It's down. Does the market, does SPY replicate this? SPY doesn't look like this at all, does it? Right? If we pull SPY up, it has lows and highs, right? It's a lot more choppy. Why is it so much more clean? Why is it so much more of a clean drop on UVXY and VXX? It's because they rot. They're connected to futures. The futures contracts decay, causing the price of this fund to slide down. Okay, same with VIX. They pretty much only go down. I've developed a trading strategy that's actually profitable that I've been testing with live money, since testing with paper doesn't really work, in the Discord. So why would you buy something that you want to go long on and you want it to appreciate? Buy a call on this. Or if it's short term, I get it. There's a perfect technical setup. Yeah, absolutely. But I see people loading the boat whenever we're going into uncertain times in equity in this. It rots. If SPY was pinned at $400 and didn't move, let's just say it jumped between 400 and 405, maybe 410. It did that for a year. This thing would look like this because the price of it is going to rot due to the fact that it's connected to futures, okay? No, it's not a futures contract, but it is connected to it. So there's the proper way, and by the way, before I go into the solution here, let's just take a look at this. This is a fund that shorts VIX, or in shorts UVXY. It's one or the other. I'm pretty sure it's short UVXY, pretty much the same thing. And the returns on it are astonishing, and it beats the S&P. So this is something to note. If there's a big crash, I could add dip buy in here, $47 to $90 from a year ago. That's a SPY hasn't went up over 100%, right? So that shows you how bad of an idea it is to buy equity in VIX, SQQQ, and UVXY when things are uncertain or you're bearish. How do you profit off something going down, right? Let's pull up SPY. Am I going to buy a SPY put? Yeah, if I was a master of technical analysis and I was on top of everything that the Fed's doing and listening to everything that they were talking about, sure, maybe. Yeah. But is that really the best solution here? Because when you buy an options contract on something $435, and there's people in all my groups, my Facebook groups, Telegram groups, and the Discord that are not subscribed that are gambling. Hey, what do you think about this? And it's like you're tossing a coin, and the probability of that options contract not making you any money is very high. Very high. Are you going to sell it immediately, but then it keeps running? You sell it at a loss, and then it keeps running. Next time, I know next time I'll buy it and I'll just hold it all the way till expiration. I'm not going to touch it. You don't know what you're doing. You're buying two things that rot and go down in value over time. SPY contracts, they're going to rot. UVXY is going to rot. VXX is going to rot. And you want these things to appreciate. So the probability is not in your favor. All right? How can I eliminate the theta decay? I can eliminate it, depending on how wide I go on the spread, up to 90% of the theta. I'm just shooting from the hip and throwing that out there. I don't have the exact numbers. But we can pretty much eliminate the theta decay by doing a debit spread. So if I'm bearish on the market and it doesn't cost that much money, I may only spend 30 or 40 bucks and have my hand in the pot, and I can also go up to a year out for 100 bucks. I can go up, 6 months out for 70, 80 bucks rather than putting 400 in, a SPY put contract that's pretty much guaranteed to rot, or throwing $1,000 of equity in VXX that's pretty much guaranteed to rot. The probability says that's all it's ever done. And UVXY, there's times where it shoots up. I get it, right? If one of our naval ships got sunk by the Chinese, it's probably not a bad idea to pick up some equity or buy some calls on VXX, UVXY, or SPY puts, right? But that's not the scenario. Just because things are looking weird with Israel, everyone's buying SPY puts and smoking their portfolio and buying UVXY. And why is it going down? I don't understand. There's bad news out, right? That's not how the market works, and that's not how UVXY and VXX work. They really run off volatility. If SPY goes down slowly, they're not going to go up. They're just going to keep going down with it, right? So the way to do that, in my opinion, the best way where the probability is more in your favor is a SPY put debit spread, right? I buy, let's just say, a $430 put. At the same time, I can sell a $425 put, right? The theta decay from the 425 put that I'm selling comes back to me as profit, right? The wider I go, the more risk and the more open to theta decay I am. The heavier the rot, the tighter I go, the less reward, but the less risk and the less theta decay. I have a video on debit spreads, I think two, if you just search Z-Trades debit spreads on YouTube, which is a separate video. But again, to recap everything here, UVXY and VXX rot and they go down. Heavier than and it's accelerated because they're attached to futures contracts. Options on SPY, they rot heavily. The more expensive the stock, in most cases, the heavier the rot and the decay. So, and the solution, debit spreads on SPY. If you like this content, like and follow for more. I'm going to be posting a lot of content, hopefully every day from here on out.